A COVID perspective on finance. It is still hard to believe a decade ago that I was working in finance as a clean-cut suit and tie business guy, especially since now I have long hair, ride a bicycle, and make pyramids with crystals in them. I'm sure most people thought I lost my mind at the time, and many might still believe that. However, finance was great until I ended up learning too much. Then everything changed. I had to be true to myself, and selling products for a fundamentally broken system was not my calling. I hope to share some of my personal experience to help others during these times of high financial stress, while also sharing some interesting perspectives about finance. To start, I initially began by running my own financial office after the 2008 crash. I decided to get involved in finance after I turned $1,500 in stocks into $20 through a series of incredibly bad trades. Sadly, I was not very successful as a financial planner either, as I learned most people in the world were broke. However, I was very successful in helping with debt management and helping to educate people to get back on their feet. The statistics a decade ago were 50% of Americans are 2 weeks away from being homeless, meaning that today many people without help are technically homeless. I was faced with that stark reality a decade ago, and it was eye-opening. I learned that most of the people I knew were broke. People who made $100,000 were spending $110,000. While people who made $50,000 were spending $55,000, and so forth. Everyone was spending more than they earned, and credit cards made it all possible. Honestly, I don't think things have gotten better for most people over the past decade. Just more debt and higher interest rates. Now people are facing something I struggled with 10 years ago. After struggling for nearly 2 years to run my office and digging myself into an ironic financial pit, I broke. I was at an all-time low as I was months behind on my mortgage, wasn't able to pay my car payments, and was always struggling to pay my bills. The subconscious poverty mindset was laid down in cement for me. So I caution people about falling into this poverty or woe is me mindset right now. Now is the time to act, even when all things seem lost. Otherwise, you may end up in a state of sadness, depression, or inaction that is incredibly difficult to break free. That happened to me a decade ago, with several similar experiences as I started my new companies. Only recently I found the poverty mindset has been replaced with a mindset of abundance, and now I haven't worried about my finances in several years. Sadly, I'm still not financially rich, but definitely not broke either. After years of stressing about how I was going to pay my bills, make rent, or even feed myself, it has been a significant relief. It took a lot of inner work and effort to get to this point, but honestly, it was worth every bit of the journey, even the worst parts. While working in finance, my bills were outrageous, as I was paying for a house, a shared office, a rental home, a car, insurances, investment deposits, and I only had one tenant renting a room in my house, which was located out of state. I was making practically nothing, and my bills were over $3,000 per month. Hardly an excellent place to be if you are a financial advisor. It may have been my pride, but I persisted through the struggles, burning through all of my savings. There was an all is lost month, not a moment, but a month, where I just didn't know what I was going to do. Today, I feel many people are going through this all is lost month right now. It was crippling and debilitating. I didn't want to go to the office, as I didn't want to face the other people in the office. However, we are being forced to do this today. It made me feel like a failure despite all my previous efforts. I had only taken Sundays off as I held events every Saturday. I still kept going to the gym and social events, hoping that something would manifest. It just so happened that it did, because I had faith it would work out. It just wasn't how I expected or wanted it. I didn't want to end up broke and struggling before the miracle happened, but it would be one of the best learning experiences of my life. Now I'm glad to have those experiences as tools to avoid ever ending up in that place again. At the end of my all is lost month, I was offered a job working for one of the most revolutionary privately owned retirement firms in the country. That was the stability I needed at that time. It was through my connections at the gym I went to daily that I received the job offer. My persistence paid off, not with clients, but with a better job. It was wholly unexpected, but because I had a Series 65 financial license, he was particularly interested in bringing me aboard. He offered me everything I could have asked for, and I took him up on the offer. Leaving my office and my team of financial planners, I moved on to greener pastures. The decision to move on was difficult and invigorating at the same time. My new boss taught me how to find all the hidden fees, tricks, and scams that investment vehicles use, which put retirees at risk. I was confident that he was genuinely doing the best thing for his clients, as he gave out most of his education for free. If you search retirement planning online, odds are his videos will pop up first. We were compensated when educated people used us to invest, which happened quite often. The boss even showed me how to tear apart investment vehicles that I used to sell at my old office. I couldn't believe the hidden fees and lack of clear disclosures that most of the investment vehicles contain. It was even more eye-opening when he told me about the hidden fees and hidden catch inside the investment product that I had put my parents into. I even hired my dad into the previous company to teach him about finance, and we still never knew the hidden catch. There were things that people just aren't being taught, including the advisors. So when I had this new opportunity to talk to people all across the country and spend hours a day educating them about what they have, I was in heaven. It felt like a calling. I felt like I was helping so many people and even helped to better educate my dad on how the products work. While I'm not saying all investment vehicles are bad, I'm saying that most people, even the people who sell them, don't know exactly what they are buying or selling. This lack of financial literacy is why we had the 2008 collapse, which is still leading into the current economic meltdown. But more on that later. I initially started in finance to educate people on simple principles like the Rule of 72 and how to start to save for retirement. Now I was discovering that there was really only one safe investment for most retirees. The reason was because most safe investments like government bonds, savings bonds, or certificates of deposits, CDs, don't return enough interest. And now with interest rates dropping to 0%, it means that retirees are even more screwed, to put it lightly. The problem then is, if safe investments don't have high enough returns, what else can you do? I could recommend the next level up would be high-grade corporate bonds, real estate investment trusts, or bond funds. These all have much higher payouts. The problems are with the risks. Currently, we have been seeing big bubbles burst in tech and housing. However, these aren't even the biggest looming bubbles. That was when my boss put things into perspective, and he would illustrate it as such. Investments that are low risk earn about 0.5% to 1%. Few retirees can survive on such low rates. These include government bonds, certificates of deposits, and savings bonds. The risks are very low because of FDIC insurance and other protective measures. However, banks are currently leveraged 9 to 1. Bill Gross, the bond king, said 10 years ago the US government is $100 trillion in debt. So will those protective measures still continue to protect us? And here's the math. US government unfunded liabilities, according to usdebtclock.org, on 4/19 of 2020, Social Security was $20.4 trillion, Medicare was $31.5 trillion, U.S. debt was $24.4 trillion, and other total unfunded liabilities were $144 trillion, totaling in at over $200 trillion in unfunded liabilities. And on top of that, the bank's fractional reserve banking simplified. You put $100,000 into the bank, banks can lend out $900,000 in return to its customers. Should banks be allowed to create so much money out of thin air? More on that later. Medium risk investments earn about 2 to 6%. They include high-grade corporate bonds, real estate investment trusts, probably have the highest returns right now, and bond funds. The risks are medium to high risk because of, default risk, interest rate risk, properties defaulting, businesses going bankrupt, but bondholders do get paid before stockholders, and there's no government protections. The math here is bond fund risks. If interest rates go up 1%, bond funds will lose up to 5% in value. However, bond risks and individual bonds offer no interest rate risks if the bonds are held to maturity. However, if a company defaults and files for bankruptcy, you will be one of the first to receive a payout. REITs, or real estate investment trusts, are risky because the properties they manage could default, foreclose, or go bankrupt, easily affected by a crash. The high-risk investments, you can lose 100% of your investment and you really have no limit to the market as long as it keeps going up because they anticipate it keeps going up forever. Really? Well, the types include mutual funds, stocks, low-grade corporate junk bonds, BC grade, derivatives, and the risks with these are high to very high because stocks and mutual funds can crash, and we've seen unprecedented crashes these days. Business bankruptcy means likely a complete loss. Derivatives and related mutual funds are leveraged 32 to 1, and there's definitely no government protections. Stock risks, stock prices can crash, can lose all money, but can also go up for massive gains. Mutual funds, same as stocks, the market can destroy 100% of savings during a crash. However, because of diversification, you won't lose big if only a few companies fall. Some funds have high fees and rarely outperform the market when comparing performance. Derivatives, these are scary because if you buy $100,000 of Apple stock, the company can create and sell $3.2 million, yes, $3.2 million in soon-to-be worthless paper investments. I hope you caught the last one about derivatives. Warren Buffett, one of the wealthiest investors on the planet, described derivatives as financial weapons of mass destruction. I completely understand when you understand a simple principle. Just like the banks can lend out 9 times what they have in deposits, hence the term fractional reserve banking, they only have to keep a fraction of the money in the bank or on hand because they have discovered how to create money infinitely. The investment banks using derivatives can leverage up to 32 times. This means that for every $100,000 in assets these investment banks have, they are lending out up to $3.2 million. And yes, that's millions of dollars to ignorant investors, which is one huge reason I'm writing this paper. The derivative market is a bubble of which we have never seen, and one huge reason I left finance. Since the top 10 banks have over $500 trillion in derivatives, it's probably something that we as a society should understand. Considering the global domestic product, GDP, is only 85 trillion. The global GDP, yes, is only 85 trillion. Considering that if everyone cashed out of the system, there would only be 3.125% of the money left over, which should scare most people. And the math on that is 100% divided by 32 times leverage equals 3.125 principal amount. Take a look at the past. When Lehman Brothers collapsed in 2008, only 1% of the money was returned to investors. Lehman was supposedly leveraged 100 to 1 by the time it collapsed because the value of the assets had dropped so much. A short market downturn destroyed their measly 3% in reserves, and there wasn't anything left. However, during this time, many of the banks that caused that to happen received trillions in bailouts, while the American public suffered because they trusted their leaders. Side note, we should consider that most Congress creatures, because they aren't people, increased their net worths between 20 to 40% on average during the 2008 collapse. They should all be in jail for that alone. But I continue. The problem the banks are currently having has to do with the repo markets, which spiked in October 2019. Coincidentally, at the same time the reported virus was released, and this was honestly a big red flag for me. However, there was a time this past October when the repo rate spiked to over 10% from a standard of 1 to 1.5%. Well, what does this mean? Well, considering it was Lehman Brothers who started the crash in 2008 by borrowing money in the repo market from the Fed, aka the Federal Reserve. The Fed, by the way, is about as federally owned as Federal Express, aka FedEx. The Fed is a privately owned banking cartel that is supposed to watch over and stabilize the markets. Instead, they seem to manufacture crashes, but I'll save that for another article. The repo markets are for banks who have extra cash at the end of the day to lend to banks who need extra cash at the end of the day. This is to maintain those reserve requirements that I was just discussing. So if banks are required to keep 3.3% in reserves, then sometimes they must borrow money to maintain those reserves. Special note, reserve requirements are now currently 0%. Yikes. However, returning to the past, if a bank doesn't seem reliable, then banks won't want to lend to the risky banks. Hence why the rate spiked to 10% in October. Unlike 2008, we are seeing the problem being papered over literally. When Lehman had to borrow from the Fed in 2008, all hell broke loose, and we saw the orchestrated 2008 collapse. Now, 11 years later in 2019, we had the same event happen, but no real action from the markets. The markets even posted all-time highs shortly after this event. This was signaling that everything is awesome, nothing to see here. This Fed intervention has been a stealth bailout. Instead of identifying the weak banks that caused the interest rates in the repo markets to spike to over 10%, the Fed stepped in to offer all banks assistance. They also made sure not to disclose the banks that were at risk, as to prevent any bank runs on the risky banks. The Fed proceeded to provide nearly $75 to $100 billion a day to banks as they quietly went through the crisis, which still has not ended. Technically, they reduced reserve requirements to 0%, which means banks can leverage money indefinitely, which is both wrong and further destroying the economy, assuming that they haven't already gone too far. When we look back at the results of the 2008 collapse, we start to understand that the 2008 collapse did something significant to the banking industry when we saw the merging of major banks and investment banks. The mergers were done to keep the cash reserves up in the banking industry. Bank of America swallowed Merrill Lynch, and now we have JP Morgan Chase. I distinctly remember the banks offering to move people's money to mutual funds or bond funds after that time, and I believe they got in trouble for this, but you would have to look that up for yourself. This means that banks were transferring assets from a 9-to-1 debt creation system to a 32-to-1 debt derivative investment system. We should truly be frightened when we start to understand that the Fed was providing assets to banks to keep potentially 32 times leveraging afloat with $75 billion a day. Now let's do the math on that. 75 billion times 32 equals $2.4 trillion. Yes, that number is $2.4 trillion. That is assuming a worst case scenario, but it means that they have potentially around $2.4 trillion in bad investments that could be bringing down the ship. I believe this is where it starts to get very interesting, and I want you to start putting more numbers in perspective. You may want to reread this paper after I explain these facts. If you took $1 trillion and spent $1 million a day since the day Jesus was born, you would only spend about 3/4 of that amount of money. Now take the estimates of the derivative market, which is sadly unknown, but still to be reported to be between $750 trillion and $2.4 quadrillion. Yes, you read that right. The estimates range by over $1,000 trillion, which is a crime in itself. But let's put that in perspective. If you had $1 quadrillion, which is $1,000 trillion, you could literally spend $1 billion a day with 9 zeros for 2,000 years and still not spend the full amount. This is how much fake money the Federal Reserve and central banking system has created since 1971, when we went off the gold standard. Now, with the understanding that the banks have potentially $2.4 trillion in bad assets, does the $2.2 trillion coronavirus bailout seem a bit too exact? They're even asking for $2.7 trillion for a full corporate bailout, which is closer to covering my $2.4 trillion estimates. It frustrates me that the bailout is going to the people who've created this problem in the first place. And the manufactured problems always seem to be naturally creating the solution, a solution that everyone seems to think is helping them. Remember the Patriot Act if you honestly believe that good measures come out of tragedy. That was simply manufactured terror for the purpose of stealing basic human rights, and they won 20 years ago. However, the powers that were will not win this time. Too many people are doing their part, as this is my part to add. My problem with a $2.2 trillion bailout for the banks is that most small businesses and individuals won't see a cent, as I am discovering from most of my artist family and the small business community. The sad truth is when we look at the numbers, it is a criminal system that pays $2 trillion in taxpayer money to stimulate the economy, while only providing $1,200 to $3,600 to those very taxpayers. There is even some more serious concern over $450 billion given in private loans to large corporations. Now let's put some finance in perspective and do some really fun numbers. So if you were getting a $1,200 check And the number of people in America is 141 million taxpayers with no kids. The total cost of that to pay everyone out, and I mean everyone, is $169 billion. Now, if half of those taxpayers have 2 kids, so they're receiving either a $1,200 stimulus check or a $3,600 stimulus check, the total cost of that is still only $338 billion. Now, if we take that $450 billion that's kind of up in the air going to super corporations, well, 141 million registered taxpayers would all receive $3,191 each. Now, if we take, let's just say $1 trillion of that and give it to every single taxpayer, well, now we're talking about a $7,092 stimulus check. Now, if we took the entire $2.2 trillion and gave it to every single taxpayer, that would be $15,600 per taxpayer. Now, let's just talk a little redistribution of wealth and take the $1 quadrillion that is estimated is in the derivatives market and redistribute that to every man, woman, and child in America. Well, that would make all of us worth $3,039,513. If we did that to every person on the planet, so all 7 billion people got to partake in this quadrillion dollars of fake money that's been created, well, they would all be worth $142,857. Well, honestly, I would never expect the government to offer the full $2.2 trillion to the people, as that would be irresponsible. It should make you consider something important. What happened to the other $14,400 per taxpayer? Is it right to put that amount of debt on every taxpayer? The money is being stolen from the people and be given to the companies with the most lobbyists. Sadly, many of the current bailouts are based on lobbying power. And guess what? The American people are not directly paying those lobbyists. We pay corporations with our purchase votes, and those corporations pay lobbyists who lobby in favor of the corporation. Most corporate lobbyists write and submit the laws that our politicians pass. We have little to no voice in Washington, as the numbers I just stated show. I think that this is the most essential part to understand. We are being taken advantage of. Poverty is not a matter of numbers, but where those numbers are going. What if every American was a millionaire? Would the rest of the world benefit from that abundance? Think about it. It could have been possible if we had kept our riches. The lack of financial literacy has literally pulled the wool over the heads of most people. People are too afraid to discuss the topics of money as they believe it is wickedly complicated. I want you to know that they make sure things are complicated to hide the wrongs that are occurring. These devices that they have been pushing as investments may be having their final days, as I had foreseen nearly a decade ago. It is a strange time we are living in, and I can't deny the uncertainty that the future will bring. I hope that the more we educate ourselves, the less likely we are to end up in the same situation again. If we are more prepared in ourselves, in our communities, and our world as a whole, then I feel we can face any adversity with universal positivity. However, we can't keep allowing ourselves to be robbed by our leaders. The Federal Reserve, in cooperation with our government, has been stealing from the people for over a century. As I watch small businesses struggle to find loans and money to stay afloat, I realize this is far more an attack on individuals and their small businesses. Many companies have already closed, and they are already estimating 20 to 40% of companies may close by the end of the year. If we are allowing them to bail out just the large corporations, then when this is all over, that is what will be left. We are passively letting those corporations rule us, and by allowing them to put profits over the well-being of our planet, we are putting ourselves at extreme risk. Many trade agendas and carbon taxes clearly show that they want to protect profits more than the people. We must protect the people and ourselves from those who wish to do us harm. It is all being put on the table, and we have the opportunity to do something about it or allow ourselves to be ruled by criminals. What will we choose? I personally think we should throw them all in jail, but that's just my opinion. After struggling with keeping my own businesses successful for a decade, I understand the stresses it brings. It isn't easy to start and run a successful business these days. We have far more businesses struggling versus thriving, especially now. It will force us to reevaluate what is important. Many people will foreclose on properties, as I did on my house. Many people will stop paying unnecessary bills, and people will allow their credit scores to tank. I will let you know I did all of this too. I defaulted on many bills during my times of struggle a decade ago. It didn't ruin my life, and it didn't cause the banks to come after me, although the phone calls were a bit annoying. That lasted until a debt management company I formerly worked with also helped me settle my debts. I was able to survive. I was able to make it through the hard times, and eventually I was able to rebuild a credit score, although I don't use it except for emergencies. I find I save more money by saving up and paying off my purchases, as we all used to do before credit cards. Now I don't have excessive bills, and managing my expenses is not a monumental task, as I have simplified my life dramatically. There was little need for my excesses, and it took going through hardship to realize what was excessive and what was important to me. I think this process will be different for everyone, and it will be up to you to decide what is essential to you. We live in an upside-down world that I believe may have just been turned right side up, but seeing the potential depends on your perspective. Thank you for listening. Please like or share this video so that others may benefit from the information contained. Have a great day.